Hello everyone, welcome back. In today's video, I'm going to be going over how to choose the best dividend ETF, or rather how to choose the right dividend ETF for you. And if you do enjoy content like this, please like the video and consider subscribing for future content. Now, I own 3 dividend ETFs. In my income portfolio, I own SCHD, NJEPI, and in my growth portfolio, I own another dividend ETF, VIG. Now, as far as dividend ETFs goes, there's pretty much an endless list. There's literally hundreds of different dividend ETFs, and all vary based on their selection method, the equities that they choose to invest in, and even the strategies that they use, whether they use like a covered call strategy, or maybe they invest in like international stocks. Maybe they pick different sectors like utilities or REITs. So I'm not going to really go over exactly how individual ETFs may operate. I'm kind of going to go over the qualities overall of various dividend ETFs, and then you can choose how you want to invest. Maybe it's based on your age, or maybe it's based on your risk tolerance. That's really what comes down to when it comes to choosing the best dividend ETF rather than the exact ETF, because many ETFs pretty much overlap. There's a lot of ETFs that are very similar, and there's also ETFs that vary quite a bit. So I just want to give you a general idea of what to look for, and don't think of these ETFs that I'm going to show you as the best. Rather, look at the qualities and then go from there. Now, the first dividend ETFs that we have basically are called dividend growth ETFs. These ETFs, like VIG or the Vanguard Dividend Appreciation ETF, don't necessarily pay a high yield. Their goal is to basically focus on a growing dividend over time rather than a high current yield. So I'm going to show you what I mean by that with the dividend growth of this ETF. So first we have the yield of this ETF, and it's currently pretty low just by looking at it. You might think that this is, not much. What's the point of investing in an ETF like this? It pays less than a 2% yield. I'm not getting much cash on cash return. Now, ETFs like dividend growth ETFs, they're basically made for a younger investor that can hold for a really long time. And what is meant by dividend growth is that every single year you're going to be getting paid more and more on your initial money that you invested. So if we look over to the left here near the payout amount, you're going to see that increase over time, and you're going to see the annual payout growth here, how much it increases as a percent annually. And you're going to see it go up all the way from 2006. So it was only paying 52 cents when you were buying in 2006. But if you were to hold, now this is about 17 years later. So imagine if you were, in your 20s buying this, and now you're in your late 30s. Your cash on cash return that you're going to be getting on that initial amount that you were investing in 2006 grew so much over time. So every share that you were buying in 2006, it was only paying 52 cents. But now every share that you own is now paying about $3.20. So your yield on cost is going to greatly improve over time. Now here's a hypothetical. So I brought up the Excel spreadsheet, and this is just going to be an example. So basically, for simplicity's sake, I did an initial share price of $100 and an initial dividend of $2. So your yield on cost would be 2%. So in other words, for every $100 you're investing, you're getting a dividend of $2. So you're getting 2% back on your cash that you invested. So now I'm going to really display the power of yield on cost. So as I said, in the first year, you're going to be getting $2 a share. If that dividend were to grow 9% consistently per year, now keep in mind, this is going to vary quite a bit depending on market conditions, but in general, dividend growth ETFs will grow to the higher end, and since they are diversified, they're going to tend to grow over time and not decrease unless there's some sort of major recession going on. Generally, they're going to increase, and I did a conservative 9%. Sometimes it's going to be quite a bit more, sometimes it might be a little bit less. So year 2, you're going to be getting paid $2.18 per share. But let me show you what happens once you get down to year 15. Now remember, this is going to be consistently at 9% per year. So by year 15 on your initial investment, that $2 a share becomes $6.68 per share. So we can do some mental math here because I kept the math easy, the initial price. So imagine you were investing $100 per share initially when you bought when you were 20 years old, and now you're 35 years old. So all that money that you invested when you were 20 years old is now paying you 6.68% on your initial cash. So hypothetically, if you were a 20-year-old that came across a decent amount of money, that's going to grow very, very well for you over time. And all that initial money is just going to keep compounding. And I'm just going to keep going a little bit further and show you how this really works. So by the time probably around year 30 happens, so imagine you're 50 years old, all that money that you invested when you were young, that's going to be paying you 17.25%. So it just goes to show you how much that dividend growth really works for you over time. And that's the purpose of a dividend growth ETF. So if you're younger and you want dividends, you should really be focusing on dividend growth. Unless you have a ton of money, like $1 million, and you just want to basically not work, and then you can focus on what we're going to speak about a little bit later. But really, when you're younger, it should be mostly about dividend growth. And now with dividend growth ETFs, they're going to focus on dividend stocks, but they're going to be more growth-oriented stocks that have growth potential overall. So that's why you're going to see companies like Microsoft and Apple, and you're going to see companies like Visa and Broadcom. You're going to see companies that may not be considered exactly growth companies, but they're going to still pay dividends, like Exxon, and that's mostly for diversification purposes. These aren't bad stocks, but they're not going to really be those growth companies. So these dividend growth ETFs are going to be more focused on dividend growth. Now, just to show you kind of another ETF that focuses on dividend growth, this is comparable to VIG. A lot of investors kind of are indecisive of whether to pick, DGROW or the iShares Core Dividend Growth ETF over VIG. And to me, it doesn't really matter too much. Both ETFs are very good. You're going to see a lot of similarities between each fund's holdings, but the weightings are going to be a bit different. If you remember, VIG did hold many of these stocks as well, but overall it is very similar. And now, because these dividend ETFs that are growth oriented focus more so on growth companies in general, they are going to perform more in line with the S&P 500 more so than some other ETFs that I'm going to show you in a bit. Now, of course, because these are dividend ETFs, they're not going to include companies that are going to be in the S&P 500 that are high growth. So you're not going to see like Nvidia in a dividend ETF or Facebook, which have performed very well and brought the S&P 500 higher. So you're not really going to perform in line with the S&P 500. You might underperform a little bit, but in general, you're going to perform a little bit better than a high yield ETF. So next up on this list, we're going to have some blend ETFs. So these ETFs are more slanted toward high dividend yield rather than dividend growth, but they still do offer some amount of growth, but they are higher in yield. So these are going to include ETFs like VYM, the Vanguard High Dividend Yield ETF, and SCHD, which is very popular, the Schwab US Dividend Equity ETF. So here we have VYM, which currently has a yield above 3%. So if you remember VIG, that had a yield below 2%. VYM has a yield above 3%. And this is also similar to SCHD. SCHD has a yield nearly 3.5%. So again, these kind of ETFs are the great middle. They offer yield and some ability to grow their dividend over time like VIG, but they are going to pay a higher current yield. So here is the dividend growth of SCHD, and you'll see that it does grow its dividend pretty well. This history isn't as established as VIG because it hasn't been around as long, only since around 2011. But you do see that it does have some decent annual payout growth over time. So you do see that blend here where it grows and you're getting a higher yield, of course. Now with these ETFs, these blend ETFs, you're going to see the holdings are a lot more, I guess you could say, established. These holdings basically all pay dividends and they aren't really considered growth stocks, except maybe some of them like Broadcom. But you're going to see like JP Morgan Chase, Exxon Mobil. You're going to see more of a slant toward consumer staples and energy with these ETFs. You see Pepsi, Chevron, some healthcare stocks like AbbVie and Procter & Gamble. And you see a similar holding criteria with SCHD. You're going to see a lot of these same companies with some slight variation here and there, but overall nothing too major. All of these companies are basically well established. They pay dividends and aren't really at their growth phase anymore. They are toward their dividend paying phase where they, instead of taking their capital to reinvest in the company, they are at the point of just paying shareholders dividends because they don't really have any better use for that extra cash flow. Now, ETFs like VYM and SCHD, they're going to be for the most part, a more established investor or for investors that don't like volatility or risk. Again, a lot of these companies are well established, so the odds of them moving quite substantially, whether that be up or down, is pretty low. So if you want a high dividend yield, maybe you already are, late in your investment career, or you just don't like volatility too much, you can go with these ETFs that pay a blend of growth and dividend, and you are gonna pretty much have your money secured, although I would not expect too much growth, but I would expect a healthy dividend and dividend growth. And if you are, like a millionaire and you put your money into one of these ETFs, you could probably live off the dividends quite well. And as far as performance goes, you're really going to begin to trail the S&P 500 here because you are moving away from growth and going into more of that cash flow. Those companies are, again, well developed and they're not really growth orientated. So these are really for investors that don't really need to or want to grow their capital for their own reasons. They are comfortable with taking a high dividend for a restriction of growth. Now with these next ETFs, we're really going to begin to supercharge our yield. This is SPHD. As the title goes, it is the high dividend, low volatility ETF. These ETFs are really high dividend yield ETFs that I'm about to show you. Their intent is to pay you a high current yield, and some of these ETFs are really marketed toward investors that want income because they pay monthly or they really have a high yield. So these ETFs are more toward your established investor. Maybe you are already rich and you want to put in all your money into one of these ETFs to live off the dividends that you get, or you are really against volatility and you want to just pick these ETFs because you don't like seeing your investment go up 3 or 4% or down 3 or 4% in a week. These funds typically are a lot less volatile, again, but they do, of course, limit growth. Now, these companies are all going to be very well developed. You're going to really start to see a slant toward communications, real estate, financials, energy. All of these companies, you're really not going to see any companies at all that would be considered tech companies. All of these companies that you're really going to be seeing in these ETFs, again, there are some caveats, are going to be not growth orientated companies. Now, I did, of course, just mention the caveat, because the caveat is there are ETFs that do have different selection and investment methodologies. So the ETF that I showed you before, SPHD, is a more conventional selection method. This ETF, JEPI, another very popular dividend ETF that pays monthly, the JP Morgan Equity Premium Income ETF, has a methodology that instead of a common methodology like SPHD, just picking high yield dividend paying companies, gives you something like covered calls, and that's pretty much an option strategy. This ETF actually uses something called exchange-linked notes. I'm not going to be going over that because this goes beyond the scope of the video. But this actually does have a decent portfolio of stocks that would definitely be considered growth in their own right. But the way that this fund operates, it uses these exchange-linked notes that operate like covered calls to pay you high income. Now you're going to see these ETFs like QYLD, XYLD. A lot of people are getting into these yield max ETFs that do pay phenomenal dividends, but they are good or bad for their own reasons. So just keep in mind, this is just less about their holdings and more so about what the yield that they're paying. So with SPHD, you are going to see a yield above 4%. Now, of course, that is really going to be beneficial to you if you need a high current yield. Now, if you're younger and you have a long time horizon, this ETF really might not be for you because the growth in some years is going to be limited. And this, if you remember, is going to look quite a bit different to SCHD. There are some years where it goes up quite substantially, but there are some years that it also goes down quite substantially too. And there are some years where it basically is flat on its return. So again, don't really look for growth with these ETFs, look just at yield. And here we see JEPI, and this yield is way up there. It is paying over 8%. And again, its investment methodology is quite a bit different. It uses an option strategy to basically provide you income rather than a conventional dividend. So it's going to be quite a bit different in the way it pays, or how it pays rather. This is also monthly, so this is definitely geared toward an income investor too. This is a great ETF for somebody that wants income or a volatility reduction to their portfolio, like me, which is part of the reason why I hold it more so than its growth. I do like that it basically is a volatility reducer. And I'm not really going to get into the dividend growth of this ETF because it does use an option strategy, and that is going to be more dependent on its underlying, or less dependent on its underlying, and more dependent on volatility in the market. And I just kind of want to show you how far we can really get with this. We have the Global X NASDAQ 100 covered call, QYLD. A lot of major yield investors do like this because of its high yield. As you see, it pays above 11%. So this runs a covered call strategy on the NASDAQ 100, and it will pay you an extremely high dividend every single month. So if you're looking for income, and again, this is just an overview of this ETF. Definitely read the perspective and other videos, and watch other videos on this ETF or these high yield ETFs to get a much better description than just a high level overview. But if you want high income, this might be a decent ETF for you, depending on what you need in your portfolio. And as I mentioned before, there are some incredibly high dividend yielding strategies. This is more so of a covered call type of strategy, but this is the TSLY Yield Max Tesla Option Income Strategy ETF. Some people swear by it. I got some comments on my previous video regarding high yield dividend ETFs, what not to invest in. I don't really agree with investing in this ETF, more so because of it's just one underlying holding. I do like the investment strategy where it does sell covered calls like 3 standard deviations out rather than a covered call at the money. So I do like this investment strategy more so than a strategy like QYLD or XYLD, but either way, that's kind of neither here nor there. That kind of goes beyond this video, but as you can see, the yield is extremely high. It pays an incredible yield due to its strategy. So it just goes to show you how far an income investor can get when it comes to yield. And now, of course, I am not saying invest in this by any means. definitely, if you do choose to invest in this, like if you're looking at this video and think like, wow, 80% yield, let me invest into it, I would definitely recommend doing your due diligence on this ETF and knowing the risks before you throw your money into it. Now, as the trend goes, depending on your high yield investment, again, this is going to vary dependent on the investment you make, but generally speaking, when you invest for high yield, your growth is going to be severely limited because of the underlying holdings or investment strategy. So I'm just going to do this on the SPHC, the Invesco High Dividend Low Volatility ETF, and you'll see that it greatly underperformed the S&P 500. Again, the premise is for income investing, for dividends, not for growth. So you're going to see a bit less volatility generally with these high dividend yield ETFs, but you are going to see greater underperformance. Again, the highlight is these are for investors that want high current income and don't really want growth. So just to kind of do an overview of a recap, remember, if you are looking for dividend growth, that's going to be more so if you're a bit younger, you have a long time horizon to really grow that yield on cost over time. You can really let that dividend growth work for you. Now, if you're maybe in your 30s or 40s or so, or you want less volatility, you can look for a blended ETF like SCHD or VYM, and you get that great combination of yield and dividend growth. And if you are well established, maybe you worked at Google, you worked at Apple, you invested in a stock that made you millions. Either way, doesn't really matter how you got your money. Maybe it was a business, who knows? It doesn't really matter. You're a millionaire at this point. You can go with a higher yield ETF to basically set it and forget it and not really worry about where you get your income from. So that's going to be it for today's video. I do hope that I gave you some ideas. Again, not so much of specific ETFs, but really what makes a dividend ETF the best for you. This is going to be highly dependent, again, on your age and where you are in your life, whether that be you're young and are a millionaire, or whether you're rich and you're a millionaire and you're retiring. It's really dependent on your lifestyle more so than it is on the specific holding that you choose. So again, I really appreciate you all for watching. If you did like this content, definitely please like the video and consider subscribing for future content. You all have a great day.